Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark looks at the latest developments on the major equity markets. Real estate consultant Ross Kay tells us no other province assesses property values like BC does, and that the BC method is mathematically flawed. He believes 80% of BC assessments could be successfully appealed. Mike Swanson from WallStreetWindow.com takes a look at where you're most likely to make money on your investments in the new year. And Mackey Research's Payton Nyquvest wraps up the action on the Canadian equity markets. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Happy New Year, Ross, and welcome back to This Week in Money.
The same to you and all of your listeners.
Fascinating headline out of Hong Kong. Their LIBOR overnight rate for banks hit 61.3%. What exactly is that, and is it something we should be worried about on this side of the pond?
Well, it's an anomalous item. We saw it last year when there was a spike up as well. And, you know, when you think of the money that flows around year-end, both sides of a border, when you get to the 1st of January here, with the mainland Chinese being able to take $50,000 and export that from the country, and you've given everybody that initial, you know, they know what the date is, where they can do that. You get that large flow of funds, and so within the banking system, that creates some real tightening on the reserves. And so with that, and the people's public, with that, and the government there trying to support the currency, which also took a significant dive, it really had a significant impact on the reserves. But that's short-lived. I think we'll see that move behind us, and then we just move into the regular action, which hopefully isn't impacted too much by the new U.S. administration and their moves towards the Chinese.
Well, I know some hefty fines were thrown around in London because it was found out their overnight lending rate between banks was heavily manipulated. Is the same thing happening in Hong Kong?
Well, you know, it could be, but as I say, these are very short-lived items. Look at what happened to the Swiss a year ago. You saw that dramatic move when there was the failure there to support the currency. But once again, that was like a 24-hour event, and within a week, prices were back to pretty much where they had been. So look for stability to start kicking back in again.
What's happening with gold right now?
Gold and in particular the mining stocks have had a pretty good move off the lows. We got down to about 1126 on gold, rallied up to the mid 1180s. The miners have done much better than that. Actually, they took out their early December highs, whereas bullion wasn't able to do that. Still looking at this as possible basing action, support still down, maybe closer to the 1100 category. Looking at the silver market, it also had a good move off the low, got up to about 1670. We're looking at the $16.80 to $17 range. There's a pretty significant resistance level for silver, and it's been, I guess, 8 days off the bottom. And the typical first rallies are 8 to 11 days. Then you would be looking ideally here, if this is a basing action, we would have maybe 2 weeks, up to 2 weeks of slow erosion back down towards the lows that we put in December, maybe not taking them out. And if we can round out down there, you've got the makings of a pretty decent first half of the year for silver. The key will be how well it holds on the support as we go back down.
crude oil prices amazingly have maintained themselves above $50 now for some time. Is that going to continue?
Well, we are just about to enter the positive seasonal period, and we've gone through the weak period by basically treading water here. I guess the problem is that this $54, $55 level that I look at presents a pretty high spot as far as the pricing is concerned. We're at the top end of channels. I really would like to see it trade back down into the $46 to $48 range to set up for a stronger seasonal play to the upside. As I say, we're probably a little bit overdone on this rally right now. We've been rallying since the middle of November on the short term, and we're almost a year into the rally from February of last year.
The Canadian dollar has managed to stay above 75 cents for a little while. Will the Canuck buck remain strong?
Well, it has clearly decided that it's going to join the parade here with the energy market for the last week or so. I think, once again, downward channel, when we look at this one from April, it got up and tested the upper end of that the first part of December. It's back retesting about 50 cents lower, or 50 basis points lower than it had been in early December. If it can tack on more than we're at right now, you might be looking at a possible trend change. But for now, still thinking that the overall trend is down, and this still can be a good opportunity for the snowbirds to be buying some U.S. dollars.
Will the U.S. dollar remain as strong as it is, or is it going to slide a bit?
The overall move that we're looking at is still bullish as far as the dollar is concerned. And U.S. dollars had a pullback this week, but I think that maybe there's another 1 or 2% in this. But overall, the index, which is around 101, probably gets up close to 110 at some point during the first half of the year.
Canada's unemployment numbers usually see an improvement in December because of a lot of temporary jobs around department stores and so on. But this December, a lot of new jobs were added, and they were permanent jobs. Is this something that Canadians should feel happy about? Yeah,
I mean, it's a first good sign. And, if you take a look south of the border, the numbers down there, for all that the raw numbers weren't all that exciting, the average hourly wage is starting to move up a bit. So, maybe these economies are strengthening enough that it's starting to give us reason as to why the stock markets have been doing so well. Here we've got new highs for the Canadian and U.S. equity markets this last week, and we're in a very strong seasonal period. You're also in the first term of a new president, and this first calendar quarter is pretty significant. Well, we would hope to see the equity markets move up with some decent economic news, and the potential of the changes in the policies of the U.S. government, clearly with this new administration. But as we move through January, we've got some really key numbers that we'll be looking for. And as mentioned last week, for subscribers of Bob's service or my clients, we've got those specific items for them that we'll be monitoring as we move through January into second half of February.
Ross, how can people get a hold of yourself or Bob Hoy to get more of an insight on what's happening with our markets?
Well, my email address is ross.clark@cibc.ca.
Ross, thank you a lot.
You're welcome, Jim.
My guest has been Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Coming up, Ross Kay, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is real estate consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show and Happy New Year, Ross.
Thanks for the Happy New Year, Jim, and the same to your family.
Can you perhaps tell us about the latest numbers from the Greater Vancouver and Fraser Valley real estate boards, and what are the numbers you've generated? What's the difference?
Okay, what the difference is again, your listeners can go and check everything that I say. I think that's important for everybody to understand. What's different about my firm is that we encourage you to go check what we're saying to find out if it's true or not. Whether you call your lawyer, your accountant, your financial advisor, or you pull up the stats from the real estate board and read them as we're talking, we always encourage you to check out what we're saying to be sure that we're telling the truth. We say that because we're talking about housing, and in housing, the truth is seldom, if ever, told. The real estate boards in British Columbia are a prime example. How many headlines, Jim, do you think you read this year that housing prices in Vancouver had increased 30 or 40%?
Well,
how many headlines do you think you would have read?
Well, of course, quite a few. And the assessments that people just received in the mail were up in some places 30 to 50%.
Yeah, that's amazing, isn't it? That's really an amazing fact to my firm here. Did you know that in Vancouver, the area governed by the Realtors Association of Greater Vancouver, the average selling price, so the amount of the average price of what a home sold for in their trading area during the calendar year 2016 only increased 13.2%. Only 13.2%. If I told you that, would you believe me, Jim?
Well, I don't have any reason not to. Of course, these assessments were based on the average selling price in your neighborhood July 1st. What kind of a drop in value have we seen since then?
That's a great question, because in July the 1st, on the timing of the property assessment was done, housing prices had increased 16.8% versus July 1st of 2015. So your property tax assessment at the very most, and for only the people that own the very best homes on the street, it should not have increased more than 16.8%. Apparently, you have crazy assessments all over the place that are ranging as high, I have heard, as high as 60% increase on their assessments. Now, I've heard lots of instances of 30 and 40%, but I have heard as high as 60. The problem you have there is that when the average was only 16%, and most people's assessments have gone up more than that 16%, the BC property assessment, which we referred to back in February of 2016 in an interview that you did with me, where I warned your listeners that this year's new assessment was going to be as incorrect as what it just was earlier this week. The property assessment, the way that they value the properties, uses a flawed methodology. The exact similar flawed methodology that the realtors use in British Columbia only province where this is done, with the use of their benchmark home price. Yesterday, there were 83 benchmark prices released for different communities and home types in the Greater Vancouver area. 83 unique benchmark prices were created for the year and released yesterday. 79 of those benchmark prices, 79 out of 83, had an average year-over-year gain, which is December is the one time of the year where your listeners actually get to hear what happened over the year and not in comparison to a previous month. in 79 of the 83 unique benchmark prices released exceeded 13%, which means the combined average of 79 out of 83 benchmark prices was higher than what the average was. I think any of your listeners who have a child in elementary school with a calculator are going to tell you that it would be impossible. If 79 out of 83 houses increased in value greater than the average, there is something wrong. How wrong is it in British Columbia? Just how misled? How much were British Columbians conned? How much was the government misled during 2016? As we ended the year, 50% of those benchmark prices released yesterday.
And we're talking on December 4th, right?
On January the 4th, correct.
I'm sorry, January 4th.
Yes. So on January the 4th, they released the year-end benchmark prices. In one of the columns in their forms that the real estate boards release, they give you a year-over-year comparison. This is the one time a year. So when you get the January the 4th reading from the Real Estate Board of Greater Vancouver, you actually get, by looking at their benchmark, you get to compare it against the average house price gain. It's the only one time of all 12 months that they release, this is the one time you actually get to check up on them without having to jump through hoops and everything else. This is the one chance you get to check. 50% of those 83 prices they released yesterday increased over 20%. They're claiming over 50% of their benchmark homes increased in price during the year by over 20%. Yet the average price only increased 13%. This means it's a mathematical impossibility unless half of the housing stock actually dropped in price during the year, which we know did not happen. This goes to show you how flawed the benchmark price methodology is and why no other province in Canada uses the benchmark price, why no other provincial media outlet reports a benchmark price other than the media in British Columbia. The media in British Columbia have been hoodwinked by the real estate boards now for about 4 years, and they have been willing participants in the inflation of the Vancouver housing bubble or the British Columbia housing bubble. So as this market turns south, and we know we're already off about 21%, as it continues to increase going forward and the benchmark price starts to catch up to what's really happened in the market, we're going to see the press increasingly come under scrutiny for not reviewing the inaccuracy of reporting fake house price news. That's right, Jim. We're actually going to brand British Columbia media for reporting fake house price news.
What should the real assessment be then?
Well, the real assessment should be for the very best properties, the very best. So if there's 10 houses on the street and they're all the same house, the very best house, they should have saw their property tax assessment go up about 26% for that one house. The second best house should have saw their property tax assessment go up about 24%, the third, 22%, the fourth, 20%, the fifth should have gone up about 18%. The fifth best house, or the fourth best house in the street should have only gone up 16%, the third, 14%, the second worst house in the street should have gone up 14%, and the worst house in the street should have gone up 10%.
Should people automatically appeal their assessment, and how easy is it to do it?
Well, first of all, it's very easy to appeal, and every single person who had a property tax assessment that went up over 12% should appeal, because 80% of those people will win their appeal if they submit the right documents.
Why do you think it's been so distorted in BC, and what method do they use in other provinces to come up with an accurate property value assessment?
There is not a province in Canada where they have moved to market value assessment in terms of determining property values and property taxation where it works, because it's impossible for it to work. It only works if the market is consistently functioning in the same way. In other words, if the real estate market had the same number of buyers buying, the same ratio of buyers buying, the same ratio of houses being bought, the same percent of house price increase or decrease going on from 1990 till 2017, then their methodology would work. Their methodology was designed in a vacuum that didn't understand or take into account how a housing market functions. Normally, that is not a problem. It gets worked out over 1 or 2 years, and a lot of provinces have mitigated that impact by bringing any increases in they stagger it over a couple of years. They don't bring it all in 1 year. But what happens where you get a market that has been impacted by an outside source, such as British Columbia, such as foreign buyers acquiring ultra-luxury class homes in Vancouver, it throws out the whole property assessment system immediately. Because of the way when the foreign buyers entered and when they exited it, it was the perfect storm to mess up the BC property assessment. If the BC property assessment was simply honest and came clean to everybody and admitted their property tax assessment methodology is flawed as the benchmark price is, because they're built on almost the exact same principle. If they were honest and simply came out and said, the methodology is not built for a housing market that has just gone through what the British Columbia market has gone through. As a result of that, we are going to leave our property assessments at what they were for 2015 for this year, and we're just going to alter the mill rate to mitigate any mistakes that have been done. All of this angst and anxiety that people are going through, or worse, there are going to be people who, like you mentioned, because of the $2 million threshold, those people are going to be financially harmed because of this inaccuracy in the methodology. I think the only way that the citizens and the homeowners of British Columbia are going to get this resolved is that as many as possible flood the local BC assessment in the last week that the assessments can be applied for. En masse, that last week, everybody should flood the office because you will stall it. The office is not staffed and cannot handle that many requests for reassessment. I believe that if you do that, and since the election at that time will be underway, or the campaigning will be anyways, you would see the BC Liberals say, wait a second, hold off these reassessments. We're going to say for 1 year we're going to put them back till the 2015 levels, and we will reevaluate it going forward.
Ross, what's your opinion of the $37,500 so-called mortgage helper that the BC government is offering to first-time home buyers?
Well, we have members of our program who are going to take advantage of it. Now, what I'll tell you is those people were going to buy a home anyways. They had already made the decision to buy. They've already been to the bank and been qualified. They're simply waiting for the market to hit the right point so when we can tell them, okay, go ahead, buy in now, this is the best time to buy. So those people are going to be the ones who take advantage of it. There is this miscommunication out in British Columbia that by giving a 37.5 interest-free second mortgage to be registered on title to people, that it's going to cause more houses to sell and prices to return to what they were. That is a simple, another absurd statement being made by people who don't understand how a housing market functions. First of all, if you are a CMHC insured home buyer, which part of the policy requires you to be, CMHC won't allow you to purchase a home knowing that a second mortgage is going to be registered on it. If CMHC knows about it and they agree, they will only agree if your qualification numbers do not include any benefit being gained from an interest-free $37.5 thousand second mortgage. They're actually going to include that $37.5 on top of the mortgage that you're requesting, and then you're still going to have to qualify at 4.64%, today's current rate, rendering this policy zero impact on the number of people who will be qualified to buy a house. If this 37.5 loan, the way that it's structured, need this 37.5, they can't qualify to buy a house anyways. So this is not going to help them one iota. This move will not add a single buyer to the housing market in British Columbia. The proof of that will be how many first-time buyers start coming back into the market because of the tax. You're going to see no movement from that at all until house prices drop low enough that the current income levels allow the people to purchase those first-time homes. You need further price reductions in the lower price categories for that to happen. So this was another bad policy by the BC Liberal government, who listened to voices who clearly have no idea what they're talking about, and it will have zero impact on the British Columbia housing market other than people who are already going to buy a house, who are wealthy enough to already buy a house, who already had a big enough down payment to say, hey, thanks. You just gave me a $37,500 interest-free loan for 5 years, saving me over $5,000 of interest. I'll take it.
Ross, thank you so much for being on This Week in Money.
Thanks a lot, Jim. Have a great week.
My guest has been real estate consultant Ross Kay from thewealthyhomeowner.ca. Coming up, Mike Swanson, next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike, and Happy New Year.
Oh, thank you. Happy New Year to you, too, and all your listeners.
We were discussing off air, it would sure be nice if we had a map to get through the first year of the Trump administration. Business-wise, do you have some kind of a chart, or are you just like the rest of us throwing darts and with a blindfold, wondering where it's going to fall, and will that work?
Well, actually, that's a good question. I'll tell you how to aim a dart. That might be a good way to answer the question. The S&P, I'm looking at the stats for last year. They got them right in front of me. The S&P 500 was up 9.77%. However, I just read an article in the Wall Street Journal this morning that said that at the end of the year, the average hedge fund was up only 4.5%. So it would appear that throwing darts, in a certain sense, would have been better than giving your money to the hedge funds, who are supposed to be the super, best traders in the world. So what I like to explain is why is it tough for hedge funds or anyone to beat the market averages. And on one hand, that 9.7% return, that's just year to date from the beginning of January 2016 to the end. If you actually go back 6 months before that, the S&P is only up like 7%. because it made a big high in the summer of 2015 and dipped into the end of that year. So the gains of the market haven't really been that big for years, really, and that's a tough thing for people to deal with. When you're at the beginning of a bull market, that's when you get massive and fast gains. In the second year, or after that big surge of gains, which can last from 3 months to 6 months, typically there is a pullback. So if you think back to 2009, the S&P 500 surged, just about all stocks surged, and then there was a pullback that summer, and then the next year the market didn't do so much, and so forth. And the longer you get from the start of a bull market, the fewer and fewer stocks that really do extremely well, and a lot of stuff can lag, and it makes it harder and harder to beat the market. So that's kind of what's happened. And if you flip and think about the gold stocks, which we talk a lot about on your show, they started a bull market last year about at the end of January, and they surged. The gold stock index ETF GDX went up like 100% from its low, and the mining stocks went totally crazy. So there you had the big gains at the start, but then you've had a pause and correction that's still going on. But despite that, in 2016, GDX was up 51.82% for the year, while the S&P 500 was only up 9.77%. Oil stocks are up about 25%. Russian stock market was up about 33%. Coal stocks were up 109%. So they went up even more than the mining stocks did. However, the NASDAQ 100 was only up 5.9%. So it lagged S&P tremendously. It lagged gold stocks tremendously, despite the dip in the mining stocks towards the end of the year. And what's interesting is that the NASDAQ 100 is what most people in the United States have focused their attention on, trading these big cap fad stocks, the Amazons, the Facebooks, Google, Netflix, biotech stocks, and so forth, because those stocks were super hot in 2014 and really up until the summer of 2015, and then the biotech sector just really diverged away from the market averages and became terrible, and it was actually the worst sector last year. So what is the point of all this that I'm saying here is that what happens in the stock market is people tend to chase the stocks that were hot the year before, and nothing has captured the imagination more of individuals in the stock market than these big cap tech stocks. And Facebook was like the most owned stock over the past couple of years, Apple too, and these so-called FANG stocks. As you can think back to 2015, I would hear things on CNBC where they would say, you know, just own these 5 stocks, Facebook, Amazon, Netflix, Google, and you just don't have to do anything else. And now those stocks are lagging the market, and since the election of Donald Trump, a lot of them are actually down, while money is shifted into new leadership groups in the stock market. So the number one reason most people are lagging the market averages, the hedge funds are doing worse than the market averages, and is that they're owning these big cap tech stocks. If I go to Ameritrade, you can, or anyone can do this, go to Google and type Ameritrade Index, and you'll find a report that Ameritrade picks out every single month. They release this, and it shows you what are the most widely bought stocks for the previous month, and it's almost always these big cap tech stocks. So the people are like chasing these things that were the, you know, hot stocks before, now not so much. And the defining factor in trying to beat the market in this coming year, I believe, is going to make sure you're investing in the right sectors and not just chasing these past fads that are so popular on television and in the magazines. To give you an example, one last example of this, last night I was watching CNBC, and they had the Jim Cramer Mad Money show, and he did a segment on the show where he said, these are the top 5 stocks that went up the most in the S&P 500 last year, and he put up NVIDIA and it was the number one gaining stock. And he said, this NVIDIA is like Oracle was in the 90s. It's just going to grow earnings, and it's going to be one everyone has to own. And he said, yes, it went up a lot, and it makes it kind of risky, but, this is the one everyone has to own because it's the top number one gaining stock. And I would assert that kind of thinking isn't enough to pick out stocks. You can't just chase something because it's gone up the most, and you got to be real careful about what sectors you're buying into and look for ones that haven't just gone up the most over the past 6 or 12 months, but look like they're going to actually be future leading sectors. And to determine that, you need a sector either starting a new bull market or a sector that is holding up and showing strength during a stock market correction, because that shows you that insiders are accumulating it and it is showing strength against the stock market. Of course, in order to be able to do that, you need a correction. The stock market hasn't had a correction now in about a year, since January, February last year, so that would require one to be very patient. And really at this point, I think that's what most people need to be doing, is wait before they buy anything else, and if they're fully invested, actually do some selling and take some money off the table and just wait for a correction to come, whether it comes next week or in 2 or 3 months or whatever. Just be patient and wait, because until there is one, you're kind of like trying to play musical chairs and assuming the music's going to keep continuing when we haven't had a pullback of any significance since really 12 months.
So really, people are mesmerized by the people I call the yell and sellers, because you'll notice when they talk to you on those business shows, they're yelling.
Yeah, they are, but the thing is, those people on these shows, typically, if you watch CNBC on any given day, the Fast Money show, typically what they'll do is talk about whatever stocks went up the most on that day, and whether you should buy or sell them. I mean, on one hand, that's topical news, but that leads to a show where you end up just talking about whatever's going up the most, and if you in fact buy these things, you're essentially chasing that day's action. If a news item moved the stock, then the news is already out. It's kind of too late, and so forth. It's a very difficult investing and trading strategy. However, to be fair to the people on these TV shows, they're forced to talk about something. If they said on these shows, look, you just got to be patient and wait for the market to drop, because then you'll get a safe entry point. There's typically a drop down to the 200-day moving average for the S&P 500 at least once a year. It happened 3 times last year. Now we're elevated way above it. In bull markets, the drops to the 200-day moving average, they make for good buy points. And even in a topping market, which is a market that goes sideways after bull market, and it could be an argument that's what's going on now, but regardless, it doesn't really matter. Either way, the thing to do is wait for a drop to the 200-day moving average. But, if I was on the CNBC show and I said, well, we got to wait for a drop to the 200-day moving average to buy, that's exciting to people, and then they're going to invite me back on the next day to say the same thing again? Probably not. So, and you could be saying that for weeks, and that's just not going to make a good television show. But I'm not, interested in making good shows. I'm interested in trying to make money myself, and that's why it is we've entered this start of the year. I've raised cash in my investment accounts just to be able to be in a position where I can wait, for some sort of correction or dip. And one thing that concerns me that made me do that is after the election of Donald Trump, the day after, I put a lot of money to work. I became fully invested. I had short positions that I had in the summer, and the market dipped a little bit, but the day after the election, I got out of all of them, and I bought financial stocks and industrial stocks and transportation stocks, because I thought those would be the right things to own, and they did go up. The Dow went to 20,000 tremendously over a couple weeks, but really since the beginning of December, the stock market's really just been floating around. The bank stocks have remained strong. Goldman Sachs, for instance, and J.P. Morgan have helped them by themselves fuel the Dow to 20,000. But most of these stocks that are transportation stocks or industrial stocks, and I've looked through hundreds of them this weekend that match these categories. These were stocks that went up the most initially on the Trump election, but by the beginning of December, almost all of them topped out, and they've been pulling back. And I can't tell really if the move is real that they had after the Trump election, or if it was just a temporary, trade that's just going to fade away. And I just need to see how these stocks act for quite some time before I know that. And the problem is that, Trump, a lot of people doubt Trump, or they don't like him, so they want to doubt him. But I have no doubt that he's going to cut taxes and eventually increase spending. And I have no doubt that that's going to contribute to some sort of economic growth. But the problem with the stock market is, I don't know what that means, if anything, for the long term in the stock market. I do believe the bank stocks are going to see their earnings grow because of interest rates rising. But the problem with the stock market is it's incredibly highly valued. The cyclical S&P for the S&P 500 is about 26, and these stocks, these industrial stocks that were going up with Trump, and they can range from anything from the Carl Icahn Enterprises to UPS to railroad companies to regional banks, factories, on and on and on. The problem is all of them got, P's of 15, 20, 25, and so forth. These aren't cheap stocks. And typically when you see a new bull market or a sector go into a new bull market, it happens with valuations at a very low level. So if you think about the mining stocks, a year ago, they'd come out of a bear market that had been going on since 2011, and they had fallen so much, they were basically pricing in, some of them, the possibility of going bankrupt. They were, in fact, junior mining stocks and exploration stocks with market caps of $1 to $5 million, that have typical valuations in the $25 to $30 million range in normal times. And some companies were going under and delisting and so forth. And what had happened was people had gotten so used to gold prices dropping that people were making predictions for gold to go to $700, $400, $500 an ounce, which could put many of the companies in bankruptcy. And at the time, that's what people are scared of. Bear markets make people afraid like that and create these super low valuations. And the thing is, the U.S. stock market, there aren't, the valuations are very high. So it's tough to know when you see something simply go up, whether that can really be the start of something that can last for a very long time or not. And when it comes to the market averages, it's nice to see the Dow get to 20,000 or near it, but I don't know if it's got much upside if it ever were to break that. And I think the best case scenario is there's another 5% gain or something, or let's say 10%, but that's not a super giant gain or return. And I think most likely we're going to see the market kind of do like it has done over the past year or two, and have its dips once or twice a year, and rally back up. And but the overall thing is sideways of limited upside. And that kind of market environment, it becomes more critical to pick out the right sectors and so forth that are kind of outperforming the averages or disconnected from them. And I think that's going to be the trick to making money in the coming year.
Mike, in the past, you've pointed out you should be looking at stock markets that have underperformed because they have nothing but breakout. You mentioned Russia. Is there anything coming up this year where their stock markets have been underperforming and are likely to really bounce this year?
Well, I would say the Russian market still fits that category. As I mentioned, the cyclical S&P for the U.S. is over 26. Russia, it's under 6. I think it's like 5.7. and it's basically the cheapest stock market in the world still, unless you look at something like the Greek stock market. But, the Russians in a bull market. It started a bull market really last year. That was the first year of a bull market, and I don't have any reason to think it's ending now. So I would say Russia is probably, if you had invested one stock market and you had to pick one out, of anything, I would pick the Russian stock market because we're only in year 2 of a bull market. And then I'd still look at gold and gold stocks, even though they've had a correction since August. I'm not sure if the correction's over or not, but this is really year 2 of that bull market also. So those are the 2 places I'd be looking to put money. But I would still kind of be careful in maintaining some sort of cash reserves, because I think it's best to wait for a stock market pullback in the U.S. And really the European markets are trading with the U.S., although weaker, and so is the Chinese stock market. So I think there's a real high possibility of some sort of, maybe it's a 10% drop or whatever in the U.S. to occur in the first quarter, and that should provide a good entry point to invest in gold or gold stocks or Russia, because those things should hold up relative to the stock market. And, the stock market correction comes, and that takes some of the risk out of putting money to work. If you don't do that, if you don't wait for that, then you've got a risk that, you get fully invested and then the Dow tumbles 10% or something, and it pushes everything down a little bit and scares you out. So I think that's a big risk right now in the market.
Mike, for our new listeners, can you maybe give us a little bit of a thumbnail sketch of wallstreetwindow.com?
Oh, sure. If you go to the website, wallstreetwindow.com, what I do is every business day I put on there the top stories of note. There are stories moving the markets and geopolitical stories. Then typically you'll see 3 to 4 blog posts too, with some comments of my own or comments from a couple guests that post on there also, and try to give people updates on what I think is going on in the markets and where they're heading and so forth. So, for instance, last week on Wednesday, I put a thing on there saying that NVIDIA had to have reversal day and get out of it or be very careful with it, even though it had been the top gaining stock, and now that stock's lagging. So those are the kind of things I look for, to something interesting to make note of for people.
Mike, have a great and happy New Year.
You too. Great talking with you.
My guest has been Mike Swanson, editor of wallstreetwindow.com. Coming up, Payton Nyquvest next on This Week in Money.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Payton Nyquvest. He's an investment advisor at Mackey Research in Vancouver. Payton, Happy New Year and welcome back.
Thanks for having me.
Payton, what happened on the Canadian equity markets the past week?
The TSX had a high of 15,621. Low was 15,339. Closing at 15,496 for the week, so pretty good start to the new year. The Venture had a high of 796, low was 765, closing at 791. And the CSE had a high of 816, low was 781, closing at 812 for the week.
What stood out in your mind for the most active stocks?
Well, gold's actually rallied pretty hard here in the beginning of the year, so a lot of the gold stocks are trading pretty well, but it just kind of seems like the general market is starting to pick up again now that everybody's back to work.
Payton, thanks a lot for being with us.
Thanks for having me.
My guest has been Payton Nyquvest, investment advisor at MackeyResearch.com in Vancouver. Well, that wraps up our show for this week. We'd like to thank our guests Ross Clark, Ross Kay, Mike Swanson, and Payton Nyquvest, and thank you for listening. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.